In this video, we will be solving the practical questions of June 2017 CS Executive paper of Company Accounts and Auditing. Let's start with the first practical problem of the question paper. By the way, we will be solving the theoretical aspects as well, but that will be part of a separate video. Now, let's come back to the first problem. In this case, we are given the balance sheet of Messrs. Rajvansh Limited. In this case, we can see that there is equity and liabilities, shareholders funds, share capital, reserves and surplus, current liabilities, and then there are assets as well, non-current and current assets. And they have specifically mentioned that there is a bank balance of 1 lakh. Then we have the detailed schedule of share capital, which says there are 2000 equity shares of rupees 100 each, which comes to 2 lakhs, and 1009% redeemable preference shares of rupees 100 each, which comes to 1 lakh. But there is some calls in arrears as well. That is amount already called up but not yet paid by the shareholders. That amounts to 500 rupees. Therefore, the paid up preference share capital is only rupees 99,500. And it is also mentioned that the calls in arrears is of rupees 20 per share, which is very important. We'll see why. Coming to the second part of the question, it is also mentioned that there is some reserve, that is 48,000, which is split into two. General reserve of 30,000 and securities premium of 18,000. Then comes current liabilities, which is not very relevant to this question. The directors forfeited the preference shares for non-payment of calls after giving due notice to the shareholders. So that is the first part of the question, where we are going to forfeit the preference shares who have not paid the called up money. And then they will redeem the preference shares at a premium of 10%. For the purpose of redemption, the company makes a fresh issue of equity shares. It is not mentioned as to how much equity shares have to be issued. That we have to calculate. And they also make this fresh issue at a premium of 5%. But after taking into account the utilization of available resources, that is general reserve and securities premium. Therefore, it's a given that we have to issue fresh equity shares, but only thing which is required is to calculate as to how many equity shares have to be issued. And they also say that all the shares were subscribed and money received in full. When we redeem preference shares, we have three sources for redemption. One is the existing free reserves. The other is issue of fresh securities. And lastly, combination of both free reserves as well as securities. But if we use the existing free reserves, we have to transfer some equal to the amount of preference share capital so redeemed through existing free reserves to capital redemption reserve account. But one thing has to be noted. Shares should be fully paid if those shares have to be redeemed. Partly paid up shares cannot be redeemed. But there is one option. We can either call up the amount due from those shareholders, then receive the pending amount and make it fully paid up shares and then redeem, or those partly paid up shares can be forfeited and the remaining shares can be redeemed. So that's what is done in this problem. So if you look at the calls in arrears amount, it is 500 rupees. And we also know that the amount due per share is 20 rupees. Therefore, we can easily calculate as to how many shares this 500 rupees is pending. So if it is 20 per share and the total amount pending is 500, if you divide 500 by 20, we will get the number of shares which have to be forfeited. Now that we know 25 shares will be forfeited, the remaining shares, that is 1000 shares, 1000 preference shares minus 25, that is 975 shares have to be redeemed. There are two things which we have to take into account. One is the amount which we pay preference shareholders, that is 100 rupee face value, plus the premium of 10% on that face value. 10% on 97,500 comes to 9,750. Therefore, the total amount required in this case would be 1,07,250 for the sake of redemption. Now let us look at the source for redemption. We have to look for source for both premium as well as capital. With regard to capital, that is 97,500, it has been told in the question that first we have to make use the existing reserve. Therefore, we will use the existing free reserve, which is general reserve in our case. So what's the amount? 30,000. After the use of 30,000 towards the capital, we are still left with 67,500, for which we do not have any source. Likewise, in case of premium, the amount which is required is 9,750. For 9,750, the source in this case would be the existing securities premium account itself. There is enough amount in securities premium, that is 18,000. Out of that 18,000, we are only utilizing 9,750. So now that we know that 67,500 is required, we can easily divide 67,500 by rupees 100, which is the face value per share of the fresh equity shares to be issued. If we divide, we'll get 6,750 shares. So 6,750 shares are to be issued at a premium of 5%. Until now, we looked into the various working notes with regard to the Messrs. Rajvansh Limited problem. In this case, we are required to, first of all, forfeit the shares to the extent of which we have not received the call money of ₹20 per share. And after that, we have to redeem the preference shares. We saw that out of 1000 shares, 25 shares were forfeited, and the rest of shares, that is 975, are now redeemed. Let's come to the actual solution, that is the journalizing part. The first entry in this case would be forfeiture of 25 preference shares. Since we have completely called up entire 100 rupees, we have to cancel the share capital to the extent of 100 rupees for 25 shares. So 25 shares into 100 comes to 2500. We have to cancel that much of capital. And in this case, we have not received only 500 rupees. That's why we had created the asset calls in arrears. Since now we are cancelling the entire share capital, we have to reverse calls in arrears. And if 2500 was the called up capital and 500 was the unpaid capital, the paid up capital in this case would be 2000. That is the amount which we have already received from the shareholders. That amount, the received amount, will be credited to share forfeiture account. Next comes the issue of equity shares to source the redemption of preference shares. We cannot redeem the preference shares using our existing resources. And also, if you look at the source, there is no source apart from general reserve. Therefore, first we have to issue equity shares to the extent of 67,500, and on that we are collecting premium of 5% as well, that is 3,375. Both put together we received 70,875. So since equity share capital is increasing, capital has to be credited, and share premium or securities premium is a liability. Therefore, once again, increase in liability should be credited, and we are receiving money to the extent of 70,875, which is increase in asset, and hence it has to be debited. Next comes the actual redemption of preference share capital. We know that only 975 shares have to be redeemed. Therefore, 975 into 100 rupees, which comes to 97,500. And on that, we are also paying a premium of 10%, which is nothing but 9,750. Both put together, the amount which is payable to the shareholders is 1,07,250, which is nothing but a liability. Since capital is getting reduced, we have to debit preference share capital. And since there is an expenditure of 9,750 regarding the premium, that has to be debited as well, and the liability, that is amount due to the preferential shareholders, 1,07,250, has to be credited. Next is a very simple entry, that is payment of the above liability. Since liability is getting reduced, we have to debit it, and since bank account is getting reduced, we have to credit it. Asset, if asset decreases, it has to be credited. That's what the asset rule says. And with regard to the premium part, we already saw that the premium in this case is coming from this existing securities premium account. Therefore, whatever we had debited as preference share premium account, that is 9,750, is now being set off against the existing balance of securities premium account. Securities premium account is a liability, and therefore it was showing the credit balance. Now that liability is getting reduced, we have to debit the same. And lastly, section 55 says that if preference share capital is redeemed out of the existing reserves, the sum equal to the nominal amount should be transferred to CRR, that is capital redemption reserve account. Therefore, we are transferring 30,000 to CRR. This is the first video in the series of many videos wherein we will be solving the problems as well as theory questions of the June 2017 CS Executive Company Accounts paper. If you have any doubts regarding the problems solved here, please leave a comment below. We'll try to solve your doubts. Thank you for watching the video. If you haven't already subscribed, please do subscribe to our channel Excel Academy for continuous updates.